Yes, hello. Good morning, everyone. Today we are going to talk about one interesting book called Warren Buffett Ground Rules. So, we always know more about Warren Buffett. So, basically, he is one of the best investors in the world. And at the same time, um, he used to invest with a principle called value investing. So, uh, analyzing businesses that is selling below its intrinsic value and then making this transaction worthwhile by holding it for long term. So this is one of Buffett's bedrock principles for his investing. So I think today I was thinking that uh, piecing out on an important book uh, related to Warren Buffett is very fine because there has been a lot of books written about Buffett by Miss Alice Crowder, Buffett, and Roger Lowenstein's Buffett, The Making of an American Capitalist. These are some of the books that written about Warren Buffett. So dozens of other books have also been written all over the years by some of the journalists, the best journalists in the world. So in 2016, Warren Buffett Ground Rules, this book was published, which is uh, which clearly explains Buffett's mentality from his partnership years. So how he was evolving as an investor. So Mr. Jeremy Miller, who worked as an investment analyst in a lot of investment banks, written this book very well. It is consolidated into two parts. In first part, he was saying about how Buffett's thinking was oriented, how he has been able to uh, maintain a structure related to investing. So we are going to see the parts in detail in this video. So the first part of the book is related to Buffett mindset related to investing. So the chapter one, which is describing Buffett's orientation towards the investing business. So we have already seen that the intelligent investor has changed Buffett life, and he was working as an analyst in his mentor Graham Newman partnership in the year of 1950s. So he was already using the principles to his investing career. So basically, what is value investing is that so you are viewing the stock as a piece of business. You are if you buy a share in a business, so you think you are a fractional owner of the business. So buying the stock is simply right like buying the same business. So it is not a ticker symbol or a piece of paper or something electronic symbol. If you are buying a share, you buy a piece of a business. So that's it. That's his basic principle of value investing. And buying below intrinsic value, which is something is a very important principle for value investing. So at the same time, you can see that here that Buffett tried to buy businesses below its intrinsic value because in the long run the market is efficient. In the short term, it is a it is always a swinging. It is a that's why Ben Graham used to say that Mr. Market phenomena in his famous book. So Buffett was thinking that his orientation towards investing is all about value. So finding value in a business. Finding value in a business literally means that you have to see, you have to see a business uh, which is which is quoted by the market below its intrinsic value. That's it. So the market is going to value that business in its own value, in its true value in the long run. That's the important principle for the value investing. So this is his first framework that he has in mind when he was starting his partnership. So the next thing we can able to see the what motivated Buffett to start his partnership is that. So he started his partnership in 1956 with $1,05,000 of capital. You know, so his basic analogy is that he just can able to compound the returns beautifully with his reinvestment profits, which can able to earn even more than the last return itself. So Einstein called the compounding is the eighth wonder of the world. So that's why Buffett was thinking compounding is going to work for him. So he can able to uh, make his fortune a big one with this principle called compounding. So he was basically a math person. So he can able to calculate the figures out of figures in his own head. So it's a very beautiful thing for Buffett. He analyzed these things in his early ages. So he was just saving from money from various businesses, and then he was just looking for some principles which he found in Graham. So Graham was very uh, famous personality in the 1950s. So we can able to see how he himself influenced Buffett and others. Even today, Intelligent Investor is one of the best books on value investing. So even investing. So today we are seeing technical indicators, but in those days, technical indicators, which was okay, which was useful to some, but Ben Graham influenced the investing well ever before because he's the one that taught investing to the layman. So he just wanted to learn. He just wanted to educate the common people about the investing world. He was not thinking. He just wrote the intelligent investor in this manner, right? So we will talk about it later. So you have to see that in the book, Buffett gave an interesting example about compounding in his 1965 letters to the partnership. So he was saying that $1 lakh invested for 20 years in his partnership, which earned 12% return for an year, which reinvested, which will be turned into $1 million. 1 million is a big money in 1965. So it's a very interesting thing that Jeremy Miller has taken from his partnership letter and then uh, given in the book, which is astonishing to see how compounding works in the real sense, in the real investment world. And the last important thing that Jeremy Miller has quoted in the part one of the book is Buffett's partnership structure. So Buffett is one of the first hedge fund, I mean, one of the uh, pre early hedge fund manager who started the business very good. So I think Buffett partnership has two main characteristics. First one is Buffett has a personal stake in the partnership. He was just investing his own money into the partnership. So this is own capital because when he started the partnership with $1,05,000, he was just investing $100 bill. But as soon as the Buffett partnership expanded into nine more several partnerships, so he was just consolidating all his money, his own profits into the different partnerships. That's exceptional because in today's world, mutual fund managers and hedge fund managers don't have a personal stake in their own funds. They just manage clients' money, with the exception to some like John Paulson, George Soros, and then some others. And the second most important thing to note is Buffett was charging 25% of gains if the returns has been gained above 6%. So the threshold is 6%. If he is not going to get more of 6%, he is not going to take his money from the partnership. So it is one of the classic thing that he wanted to be structure the partnership in a way that is win-win for his investors and for him. So it is one of the best important thing we have to note here. And the important thing again is he has a very unusual ability to beat the market. He was saying in, I think, in the uh, 1998 Berkshire Hathaway letters to the shareholders. So he was saying that when I was managing small sums of money, I was killing the Dow. So Dow means Dow Jones Industrial Average. That's it. So he was a very exceptional person. So without it, it would be impossible. He has no a single lost year. So we have to think about it. So today, even today, many investors struggle to find better returns for the investors. But even though it was not a very competitive period in the 1950s and 60s when the liquidity was very low, but Buffett has a very uh, successful years. So he was beating the market. If market is compounded at 7%, he just wanted to be compounding his return at 17% to 20%, maybe. But he is doing well. I mean, in those days. So this is one of the best thing about Buffett. I mean, that separates uh, today's hedge funds and mutual funds and Warren Buffett partnership years. So, and the basic thing we have to note here is, so in those days, the industry was still in the nascent stage. So there was not very much of mutual funds. There was not institutional investors investing in the market. I mean, in the 1960s, late 1950s and 1960s period. So Goldman Sachs, Mr. Gustav Levy was inventing the block trade in the 1960s range. So I think the market, the whole stock market was still in the nascent stage. But Buffett has something in his mind that he wanted to deliver what he has promised. So he just wanted to um, give uh, meaningful returns to his investors. That's why, in 1969, he closed his partnership because that was an era of go-go years. The market was going up and up, and he couldn't find enough opportunities. The conglomerate era, it was uh, very much a conglomerate era when companies tried to take over other companies with inflated price to earnings multiple and convertible debentures. So this kind of things was happening in the 1960s. I'm not going to delve deep into this subject. Our subject is Buffett. So basically, I just want to finish this video with one thing, the part one of this video. I mean, today the bedrock principle of Berkshire Hathaway's shareholders. That's why it is called the Woodstock of capitalism. Buffett's annual meeting is called the Woodstock of capitalism. So people wanted to go to Omaha to attend the shareholder meeting of Berkshire Hathaway because they trust Buffett. They entrusted their money to him to deliver the returns that is more or less compounded into a major fortune for them. So that is more important. Buffett also has this ethics in his mind. He just wanted to treat his shareholders well. He was a person, and he is a person today who is working for his shareholders. That's why Berkshire didn't buy back his shares for a lot of period of time. That's one of the classic thing. He just always wanted to uh, consult his shareholders before taking any decisions. Even in a lot of time that he is going to be very honest with his shareholders. That's very beautiful to see. Even in today's environment, it's not really you can able to see that people, CEOs in a corporation used to change. But Buffett is same as before. That's why he is the best and he is the great. Thanks for watching the video. We will come up with the part 2 of this wonderful book, Buffett's Ground Rules.